Good evening, viewers. Today we are going to resume with our series, financial reporting, and our emphasis for today is going to be on how we account for the valuation gain and the valuation, and impairment loss. This is now the third video about the IS 36 impairment of assets. And the first one was about the theoretical aspect. We did the second one, and it was showing how we can be able to identify whether the asset is impaired. And we did the computations. We showed how we treat the impairment loss, the financial statements, and now we are looking at instances where an asset that had a revaluation gain in the previous year, and that revaluation gain was taken to the OCI, or statement of other comprehensive income, and that is the part that comes immediately after the net profit. And at the same time, that same asset in this very year, on the current year, the asset is going to be suffering an impairment loss. And we are looking at scenarios whereby if that happens, then how are we going to be treating, or which figures are we going to be taking to our financials as far as recording those assets in our balance sheet is concerned. So today the main question is going to be about the basics. We get the basics, and it's going to be our simulation 6, where we are going to be looking at that scenario where we have a valuation gain in the previous year, but in the current year, the asset is going to be impaired. We want to see where we are going to be recording these values. And without wasting more time, hope we go to the question and we try to pick what we can be able to understand. Saying that an asset had a carrying amount of 10 million on 1st January 2020, and they are saying that on that same date, it was revalued to 20 million. So if the asset had a carrying amount as of 1st January 2020, but when they did the revaluation, or when they revalued the asset at that same date, found out that the recoverable amount is going to be 20 million. And they are saying that an impairment review on 31st December 2020 revealed that the recoverable amount was 8 million. And the required says show how the asset will be accounted for in 2020. From that question, we are saying that an asset had a carrying amount of 10 million on 1st January 2020, and on that same date, it was revalued to 20 million. And from that point, we can see that there was a revaluation gain, because the asset was the carrying amount of the asset was 10 million. Remember, we said for a revaluation gain to happen, the carrying amount is going to be less than the recoverable amount. In other words, we are going to be having, if you are to sell off this asset, we are going to be getting a lot of money other than, or which is in excess of the recoverable, of the carrying amount. That's how we get the carrying the revaluation gain, where the carrying amount is lower than the recoverable amount. Because we are seeing the recoverable amount is 2020 and the carrying amount is 10 million. But make sure when you are comparing this information, you make sure that the information you are comparing is at the same date. Because if, let's say, these assets were depreciable assets, you may find that if they give the carrying amount on a different date, you have to look for the depreciation to make sure that you get the exact carrying amount on the same date when they did the devaluation to be able to give a right figure. So now we are seeing that we have that revaluation gain of 10 million because it will be the 20 million minus the 10. So that gives us that difference of 10 million as the gain. And how we record these gains, we always debit the asset because the asset is increasing in value. We debit it by 10 million and we credit the OCI. That is statement of other comprehensive income. And it is that part that comes immediately after the net profit has been computed. So it means in the income statement, that thing is shown after the net profit. Then in the balance sheet is presented as an equity component, as a revaluation surplus and the equity section. Now for the asset, if you are to take the figure as at that same date of 1st January 2020, you will find that the amount you're going to be taking in the balance sheet will be the 20 million because we will be taking the value of the asset at the recoverable amount, not the carrying amount that the asset had. So we are seeing that even, again, from the question, we are seeing that we had an impairment. The impairment was done as of 31st December 2020, and it revealed that the recoverable amount was 8 million. It means the other one was 1st January 2020, and now we are looking for 31st December 2020. That's a difference of 1 year. So if it was a depreciable asset, you would have to compute the depreciation expense, but that depreciation will be computed on the revalued amount. Since the asset wasn't specified whether it was either land or non-depreciable, then we don't need to compute the depreciation from here. So from that last bit, we are seeing that, again, we are seeing that the asset is now going to be reduced in the value. Remember, the carrying amount, the new carrying amount, which is the valued amount, is 20 million. But as of 31st December, they are saying that the recoverable amount now changed to 80 million. It means there is a general fall in the value of the asset, which is accounted by an impairment loss. So since we are incurring an impairment loss, because the carrying amount is higher than the recoverable amount, we say that we are having an impairment loss. So having known that this carrying amount of 20 million is higher than the recoverable amount of 8 million, it means it creates a difference. And that difference is going to be the impairment, which is 12 million. So what will happen is that this 12 million we've got today, we will not record the whole figure because the same asset had a previous gain that was registered for the year, for the beginning of the at the beginning of the year, we had a gain. So if we had a gain there, it means we have to first of all use this loss we've got to make sure that we first reverse the previous gain we got. Because what happens is that this gain we got, we took it to our income statement and we added it to our net profit that we got for the year. But in the normal case, in the normal business, we shouldn't be recognizing those gains because at the end of the day, they are not realized. So what we do, this loss we've got, the impairment loss of 12 million we've got, we shall use that 12 million to offset the gain we got last year, which was 10 million. So the balance of the 2 million is what will be taken to the profit and loss as an expense in regards to the impairment losses. But the 10 million will make sure it cancels the gain we had in the previous year. And that's how everything is supposed to be recorded. But what you have to note from here is that if at all we had a revaluation loss last year, and today we are having an impairment loss again, then it means we are not going to be reversing anything because all those items, the revaluation loss and the impairment loss, all of them are going to the income statement as expenses, or they are deducted from our gross profit. So there is no need for that adjustment. That's why we don't talk about it. The only challenge is that if the asset had a gain in the previous year and now it is going to be having an impairment loss. So let's go to our Excel and we try to do the computations, but that's what we should be getting from the analysis of the question they have given to us. So when we go to the Excel, we are going to just summarize what we actually discussed. So we are seeing that we have the carrying amount. Let's start with the carrying amount we have. And the carrying amount is on the date of is on 1st January 2020, and the value is 10 million. And we are seeing that even the asset was revalued then the revaluation, when the revaluation took place, devalued, devalued to 20 million. 20 million. Then we are going to be, if we get the difference, we said we are going to be having a revaluation gain. And this revaluation gain is going to be the difference between the 20 million minus the 10 million, which will give us a difference of 10 million. Remember, this was revalued at the same date, which is 1st January 2020. Since we've got that, we said we first register this one as a debit to the asset account, show that the asset is going to be increasing in value by 10 million. Then we credit, first we credit the OCI, need to use OCI, that is other comprehensive income. And this one is going to be in regards for our evaluation gain. Evaluation gain of 10 million. Then this asset now will be carried at that same date. The asset will be carried at the revalued amount. Can put it here. This the asset will be carried at the revalued amount. Revalued amount of 20 million. That's what we will be using to account for subsequently accounting that asset. And now, after doing the impairment review on 31st, then the impairment review. Impairment review. It was there on 31st December 2020. And we found out that this we found out that the recoverable amount as of that date recoverable amount as of 31st December 2020 was as 8 million. But our carrying amount as of the same date our carrying amount still remained the same. Of course, it was still at 20 million because we didn't have any depreciation, which would have reduced this carrying amount of 20 million. But if we had the depreciation, we'll deduct it from here. But since we never had, then it means we compare this and that, be able to get our impairment loss. Impairment loss. And that impairment loss is as a result of getting the 20 million less the 8 million, which will give us 12 million. And this 12 million is our impairment loss.